Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, one market that seems to be on everyone's mind is the US dollar because the US dollar's continued to show strength. Recently was in the 109 region. Today is just under 109, and quite frankly, the trend looks like it is still higher. The dollar went through about a month long natural looking correction and has just screamed higher in the last about 2 weeks of trading. A lot of people are watching this 108, 109 level, but even more seem to be watching this 120 level that's even higher. Jordan, how do you view the moves in the US dollar recently?
Well, Corey, I looked at some history and I was looking at 52-week moves in the dollar, and there's a few charts like that floating around. But if you look at it just a simple rate of change over 52 weeks, the dollar is not quite at, that move over 52 weeks is not quite yet at a level that has corresponded to significant peaks. And so when we're looking at just pure technical analysis and price action, the dollar made a big breakout above 103, 104. And that's really significant because the dollar was consolidating for 5 or 6 years or so in this pretty big range. So the dollar breaking out from that range, it has a minimum upside target of 118, 119. And of course, if we're looking at the long-term chart, there's quite a bit of resistance around 120, 121, which was the 2001, early 2002 peak. So I think the path of least resistance continues to be higher. I mean, one thing I'm thinking about is secular peak in the dollar or intermediate peak. So that's something interesting to consider over the coming months. But we'll have to see if the dollar steadily rises from here or if the rise becomes more vertical. And also at some point, the dollar strength will be bullish for precious metals. And I mean, some people are saying that the dollar surging higher, that could force the Fed to have to stop hiking rates. So there are some interesting cross currents here, but for the most part, generally, path of least resistance is higher. The euro and the yen are, well, the euro especially is a basket case. But I think the dollar is going to be able to reach 120 before we see at least an intermediate term correction in the dollar.
Well, Jordan, if the dollar was to get up to 120, that would match where it peaked out in 2001, where it kind of did a double top around the 120 area, and then it's pulled back for ever since then, really. So if it got up there, some people are saying that would be a massive double top, where if it gets up to that 120 level, do you think that would coincide if it did get up there and roll over? Would that coincide with the change in the fiscal and monetary picture, not just in the United States, but just globally? Because it would mean that all other currencies keep weakening relative to the dollar, like the euro, the yen, the pound, the Canadian dollar, until it gets to that level. And I guess what in your mind would reverse the dollar, or could it just keep going even higher and break out to new highs? What would the catalyst be macro wise that would cause a reversal in the dollar?
Well, the first thing I'd say is calling it a double top immediately shows a misunderstanding of the double top pattern. I mean, I am a stickler for these things, being a technical analyst by trade. But typically, a double top or a double, especially a double top pattern, is they tend to happen in shorter time periods because you have a market make a high, then it has a correction, and it rallies up and basically fails at that point. So that's how you tend to have a double top. I mean, not something that goes over 20 years. So I don't know if that necessarily means that it's automatically going to peak at 120. I think one thing to keep in mind is gold leads the dollar at key turning points. Going back to my last answer, it depends so much on the impact of the dollar trending higher here from 109 to 120. I mean, how fast that happens, what kind of negative things develop in the economy and in the global economy. And I mean, if it's a full-blown disaster across the board, then you'd have to see a real shift where the Fed would not only have to stop hiking, they probably would have to cut rates. Central banks around the world might be cutting rates in concert with the Fed. So that's, one scenario. You also have a scenario where the dollar, it doesn't really make a vertical rise and it just steadily trends higher over the coming months and, eventually reaches 120 and maybe things are getting worse here and there, but you don't have like a full-blown recession yet or a full-blown global recession. I mean, that's also a scenario. But with respect to precious metals, they typically lead the dollar at key turning points. Again, the precious metals are going to be dependent on Fed policy. And so economic developments, market developments will lead Fed policy. So the things to watch for would be, do we see the stock market trending lower towards that low? Do we see the 2-year yield peaking at some point and declining? If we see those things and then we see gold firm up again in relative terms, if we see those things happening as the dollar is trending up towards 120, then those could be some signals that the Fed is about to shift course. And in that setup, you could get a peak around 120. So with respect to the dollar and the impact it's going to have, it's hard to predict exactly, but you definitely want to keep an eye on these other markets that could be leading indicators. For example, the 2-year yield, various yield curves, the 3-month against the 10-year, is that inverting yet? Also when you see the inversion, and then typically you see the yield curve start to steepen when short-term yields start to fall because of economic weakness, economic concern, and then the Fed has to follow that, shift course, and cut rates. So that's another thing to watch. So I know that was a lot to take in, but those are the things I would focus on with the dollar. I'd focus on other markets, Fed policy, Fed funds futures, the 3-month to the 10-year yield, the 2-year yield, things like that to see how impacted they are by dollar strength.
Jordan, when you're looking at individual charts right now, when it really does sound like the macro picture and the Fed policy is really what's driving these markets, do you tend to look at longer dated time frames like the weekly or the monthly chart more so than the daily during these sort of corrective periods, but also, again, when macro forces seem to be driving so much?
Well, the thing with weekly and monthly charts is they apply to longer time frames. So if you're just looking at a daily chart, that's something that probably applies to the next month or two. To give an example, if you're looking at a weekly chart, that could correspond to a longer time frame than the daily, of course, and then you have monthly and even quarterly charts, and that can correspond to significant time frames, 6 to 12 months and even greater. I mean, it depends on the market, but the with respect to the dollar, I mean, it's the chart is pretty clear in that it's had this significant breakout, and I mean, everybody knows that 120 is the next resistance level. So, I mean, whether you're looking at daily, weekly, or monthly right now, they're kind of showing the same thing. I mean, it's a good question because when we're trying to assess major turning points, you do want to look at weekly and monthly charts, and you do want to look at a big slice of history and not just the last 6 months or a year or two. Because again, when you're looking for a significant turning point, you definitely want to look at a weekly or monthly chart to see which have been the key levels over, the last 3, 5, 7, 10 years, and not just what are the key levels on like a 6-month or 1 or 2 year chart.
Well, Jordan, just along that same line of thinking about looking at larger time frames and looking at history as a guide, you had mentioned before we started recording that you were doing some research into the period of time, I think it was 1968 to 1970, and just some of the parallels that you're seeing in many markets to that same time period. I'd love you to outline that for us just real quickly, what you're seeing in the historic analog that you looked at.
Okay, well, when you look at a lot of things in general, they've been pointing to the mid to late 1960s, especially when you look at gold against the S&P 500 or even gold stocks against the S&P 500. I mean, gold stocks did do really well in the early to mid 1960s. So it throws off the ratio, but only a little bit. And so if you're looking at 100-year charts and you're also looking at expected returns, I have an expected returns calculation. So when you're looking at that and these precious metals ratios to the stock market, they all point to the mid to late 1960s. There's a lot of similarities there in the setup. That's a conclusion I've had for a while, but I just realized the other day when I was looking at silver and doing some historical research, when you look at the 1968 to 1970 cycle and that bear market and downturn, there's quite a few distinct similarities to today. And what's really interesting is the rate of inflation broke out. It had a mini breakout in 64, 65. Then in 1968, in the first half, it had a significant breakout. It broke to a 16 or 17-year high. And then the Fed, I believe, I wrote an article about this. I believe it was 68 to 70, or I think it was 67 to 69. That's when they started hiking rates. And so they hiked rates from, I think, around 3% up to 7% or 9%, something like that. But basically, so you had this breakout in inflation. This is basically the most significant breakout in inflation. I mean, you did have in the 1940s, but that was a much different period. So this was really the first time, maybe in, I don't want to say history because that's too strong of a word, but it was the first real time that you saw inflation increasing, making a major breakout, and it was becoming embedded in the system, and the Fed really had to deal with it. So that's very similar to what has happened today. And the Fed was able to hike rates a good amount then. You had a recession, the stock market went down 38%. So that's very similar to today in that, the Fed, this is the first time they've had to deal with inflation in roughly 40 years. The other thing that's really interesting is, of course, the gold price was fixed, but the gold stocks in silver peaked close to 2 years before the peak in inflation, which is really similar to what happened today, where we had the peak in precious metals 2 years ago, and the peak in inflation was maybe a month or two ago, so almost 2 years. So you have that similarity, on top of the inflation breaking out, the Fed having to deal with it for the first time in a while. So that's really interesting to me. And silver during that bear market declined 50%. The gold stocks declined 60%. But I mean, the gold stocks, they had a really good run from 1960 to 1968. So that's different than today. But if we're just looking at some of the big picture similarities, they are pretty similar. And if we look at how things bottomed, and again, we talk about gold stocks because the gold price was fixed back then. Gold stocks bottomed 12 months after the S&P bear market began. Then a month later, the Fed cut rates. All of that is one potential analog to today.
So, Jordan, just a quick follow-up then in terms of the reaction of precious metals, silver in particular, but comparing it to U.S. equity markets during that time period and subsequent to that time period, what did we see in the charts? Because I think that's key to understand.
Okay, Corey. Well, this is important. I actually forgot to make this point in the last answer, but if you look at the ratio charts, if you have silver against the S&P and gold against the S&P. Now, the gold price was fixed, but gold would have made a move in the 1960s, but not a huge move. So it wouldn't have looked that much different. But if we're looking at these ratio charts, like in 1970, and I think I posted this chart in the article that I wrote yesterday, they look really similar to how they look right now. In other words, you look at silver against the S&P in 1970, it's sitting like at a 50, 30, 40, 50, 60-year low at that point. Now the gold stocks are obviously not quite as bad because they did have a move in the 60s, but they still, they declined 60%, 61% in that bear, whereas the S&P was 38%. So that ratio came back down significantly, even though the gold stocks were off the bottom, but they still were, compared to the 50 years of history before that, they were still really, really close to a historic low. And, the same thing, if you're looking, I've showed charts like this, if you look at gold against the S&P, if you're looking at a 100-year chart, go back to the late 60s or 1970, the ratio, it looks exactly like it does now. I mean, you had a bunch of years where it really didn't do anything before it started to move up. And it's really interesting because if you were in 1970, you could, or 1969, or say 1970, 1971, you could look at these ratio charts and think to yourself, well, we just had a breakout in inflation, and it broke out for the first time in decades. It went from I think 1% to almost 7%. It was steadily climbing for 5 or 6 years. And yes, we have a correction in the market, but these ratio charts are like at 50-year lows. Like what the heck is going on here? That's very similar to today, where you look at these ratio charts where silver has broken down, and silver against the S&P has broken down. It's trending towards, potentially, if I'm right, it could potentially test that all-time low on the ratio. Gold against the S&P I mean, gold stocks against the S&P are trading, that ratio is now trading close to all-time lows. And you have to be thinking to yourself, well, we just had this huge increase in inflation. We had to move in the market. I mean, what the heck happened relative to the stock market? Like, we're near all-time lows. So that's another huge point that I'm sorry I forgot to make it earlier, but that's another thing that's really interesting is how in real terms these markets looked very similar, today versus back then in 1970. And people must have been thinking, well, we had inflation and look at where these things are now. They're never going to move. Precious metals are dead. So it's important to understand that precious metals, it's really once the inflation becomes embedded, you get into a secular bear market in stocks. That's then the setup to have that real bull market for a decade or even longer. And so we're not quite there yet, but we could be talking about how we're there, 12 or 18 months from now, maybe even 6 to 9 months from now. And again, that's why watching the stock market is going to be so important for, what's the outlook for our sector over the next decade.
All right, Jordan, we'll wrap it up there, but it gives us some historical reference possibly to where we are, and it just sounds like we are still just stuck waiting to see when the Fed will pivot. And on top of that, if the markets are going to break down and force their hand maybe earlier than they want. That will only be told by time, but it's something interesting to follow along with, and I do think that following the charts too can also be a good indicator of where the markets, where economies might go. Jordan, thank you as always for your time. We'll chat again next week. Have a great rest of your week.